Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
It's Sunday morning. Welcome back for another weekly market recap. A day later compared to the usual schedule, but I just figured, since for some strange reason the YouTube metrics are telling me that a vast chunk of my audience is actually US based, I thought, you know what, these guys are probably out celebrating the 4th of July, so no one is going to care about the video, so I just postponed that. Anyway, happy anniversary, I guess, to all the US-based folks out there. 250 years birthday, I guess. So, I mean, quite a milestone there. Now, as for the rest, I mean, at the end of the day, it wasn't a big deal because the market was particularly boring this week, I guess. For the most part, it was just a pullback. A lot of stuff which were plummeting, they had a little bit of a bounce, and that could be the story for all the charts, right? So, you know, I'm going to tell you a bit more of data and, you know, slides, a little bit less charts, because quite honestly, there's not a lot to say about charts, right? So let's start out with the economic calendar. The week was, you know, particularly rich of macroeconomic data. And we started out with JOLTS, job openings, which the print was good enough. So, you know, at the beginning of the week, at the very least, we could have hoped for a nice week of labor market data. Problem is, it wasn't like that as soon as the other data came out, all right? And look, the ISM manufacturing PMI, it kept, you know, maintaining itself at relatively high levels for now. So this one, it's, I guess, kind of good, especially if you look at the employment component of it. As you can see, it's staying at relatively high levels, even compared to the recent past, right? The past 5 years. Now, here's the thing. I think even in here, you have, at this point, you must have heard about the K-shaped economy or the discrepancy here, the divergence there. I think it's another one. Like, what was it? Last week, we were talking about GDP numbers coming out, right? Now, it wasn't stellar to start out, right? It was around 2.2, something like that. The thing is that the majority of that GDP growth, so economic output growth, I think it was estimated around 70-75%, was all due to the AI data center build out. So it kind of makes sense that when you look at the manufacturing sector for now, it looks like it's shining because there are a lot of money being put in to build up all the infrastructure. And it's not just about, you know, semiconductors. When you start to build up these huge projects, there is a lot which is gravitating around it, right? So you need to build up new facilities, new roads, maybe new bridges, and then you need the services around the data centers. So it puts in motion a lot of stuff, which I think is reflected in here for now. How long will it last? Well, I guess up until the point you have these CapEx expansion toward the AI build out, which, by the way, a lot of people are already starting to revise it for 2027. So again, we'll see about that. But for now, I think the key part is to understand why this data is a little bit in contrast with what we are going to look at later on. And, you know, there is a legitimate reason for that, okay? Now, non-farm payrolls, okay, so we start to get into the bad stuff for the week. It was a miss, all right? Not only it was, you know, lower compared to the previous reads, which, by the way, they were revised to the downside. Once again, it looks like a movie we already seen last summer, if you remember, right? But, you know, the number, the figure was pretty below expectation, 57K, and it was expected at around 110. So, you know, huge miss. And the thing is, I guess, let me find it back. Oh, here you go. Employment in leisure and hospitality declined. That's a new thing because up until this point, if my memory is serving me correctly, leisure and hospitality, it was one of the sector which was holding up those quote unquote good numbers, good prints in the NFP. So, I mean, seeing it now coming back down, it could be, as they say in here, it could be that a lot of those hirings in those sectors were front loaded because of the FIFA World Cup, which was, hosted in the US. Still, I guess it's still in process, right? Yeah. And, and now we are seeing a little bit of a payback period, right? Usually you expect, due to seasonal factors like people going on holiday, so you need more workers in leisure and hospitalities because people are traveling more. Could have been this time around that we've seen all that dynamic being front loaded a little bit because of the World Cup. It could be, but nonetheless, figures are not good for real. And again, if you look, just because I mentioned last summer, see why I'm saying it kind of looks like a replay, right? The 2025, we started out in February, March, April, May, June, July. See how many revisions we got. The initially reported figures were these one in the dotted columns, right? The transparent columns, and then they were revised lower. So, could this be the beginning of something like that? Maybe not to the same degree, who knows, but the pattern seems to be right there. So we'll see. It will take up until September to be, confirmed. But, for now, it looks like it may be something similar. Again, similar doesn't mean it's going to be worse or way worse or catastrophically worse than that, but it could be a similar pattern, all right? And if you look at, the household survey, it's even worse compared to the headline numbers from the BLS, all right? Because if you combine the last, 5 prints, it looks like the economy lost 833K jobs. So it's, it's a huge number if you think about it. So again, the labor market, it was looking resilient on the surface. And again, we were saying, oh, it looks resilient, right? I mean, if you just look at the data, the problem is, and I guess, with all the shit I threw at Kevin Warsh throughout his first press conference, that, the whole thing about the task forces and whatnot, but the goal, the aim of getting back to a point where we can, they can have much more reliable data, I think that's a good endeavor, because when you set up monetary policy, one of the biggest criticisms to the Fed is that they are always setting up monetary policy looking in the rear mirror. So, you don't have real-time data. And most of the times what you do as a Fed chair or as, the committee is that you are just setting up the policy now, but you are working on data which are lagging the real world by what? 1-2 quarters, maybe. So, I guess that's a good thing to do. And again, if you think about the employment level, we are not really seeing improvements when you account for the participation rate. All right. So again, look at this chart, right? Look at the numbers. There is a nice explanation in here, which is basically what we're going to look at when we look at, the unemployment rate, of course, which it ticked down 4.2. And why? Well, because if you look at the U6, it's already higher than that, 7.9. But the big story is in here, right? So if people are dropping off the labor market, right, what do you think is going to happen? Sure. The headline unemployment rate, it's going to tick down, but not because people are finding new jobs. It's just because people are dropping out. They are just, defeated, depressed. They're not even looking for a job anymore, right? Because again, if you think about how the number is calculated for this one, if you don't apply or look for a job for 4 weeks, you drop off the calculations for this number right here. So, look, I was looking for a job. It's been 6 months now. You know what? This month, I give up. I'm not even applying for this because every time I apply for something or I schedule an interview, I get rejected. So you know what? This month, I'm not even going to try. Guess what? they count you out, and so you don't, as for the scope of this number right here, you don't count in. So you're still unemployed, you're just not registered in the official unemployment rate, right? So again, the labor force participation rate is actually pretty important when you need to account for the overall picture, right? And then what we got, average hourly earnings, and you see they are on the decline, even in here. And I guess even weekly hours, yeah, they're going down. I mean, they have been at this level for a year now, as you can see. But if you think about where they're coming from, 2021, 22, you see that, again, it's another testimony that it's not just the media, right? I mean, I get it. There is a little bit of a tribalism even in here, because a lot of people are moaning about the K-shaped economy. And there is another cohort of the population which are saying, oh, those are the lazy people, right? That continuously moaning. But if you look at the numbers, the US economy is performing fantastically. So if they cannot take advantage of that, it's just because it's their own fault, right? They don't want to put in the effort, to put in the hours. And I think both camps actually have legitimate argumentations. So I'm not siding for one or the other. I'm just saying that the phenomenon is there, and it's clear in the data, and it's easily understandable why a chunk of the population is moaning, right? Now, from there to say that you should elect a socialist mayor in New York, it's a whole different topic, and I don't want to get into it right now, okay? But look, to finish up with the data, let's have a look at the wages and salary growth. Now, why it is important? Well, first of all, again, as you can see, after the peak, it constantly declined, right? So it ties in well with the other previous data set that we got. But it's important when you look, for instance, at inflation expectations. And as you can see, they bounced a little bit maybe this week, but they are plummeting for now, right? After the energy crisis was resolved and all the rest, right? Oil got back down to what, 69, 68. WTI, Brent, the European benchmark, I guess it was around 71 or 72. So looks like the situation has been resolved. And look, what do we always say when we talk about inflation or inflation expectations? What do you need in order to generate inflation? You need economic growth, right? So if you don't have it, it's going to be hard to get inflation. And what do you need to generate economic growth? You need people to spend money, the economy to keep on spinning. Is it easy to keep on spending if you're seeing these as a consumer, right? So again, I think everything is linked at the end of the day. Like, for instance, look at GDP. This is the Atlanta GDP now, right? So Atlanta Fed. And for Q2 2026, they actually revised lower and lower these expectations down to 1.2. Now, look, again, sorry, we have been talking about the Atlanta Fed GDP now for a while. And, my understanding is that it's a data set which is particularly volatile, but, nonetheless, it can give you a clue about at least expectations, right? So seeing them revising the numbers so low and so quick, I don't know. I mean, could this be a telltale sign? Guess we will need to wait out. Look, overall, again, I think at the end of the day, if you try to look forward 6 months and you think about what GDP will be at the end of the year, 2026, probably it's not going to be like last year, 2.3%. Could you see a drop? Yeah, but I'm not seeing it down so much. Maybe it will drop from the last year was what, 2.2, 2.3. Maybe it will be down to what, 2, 1.9. But I think it's still gonna hover around the round number, 2%. Maybe slightly below. Who knows? It depends on this capex story, I guess. At the end of the day. Which, again, is holding up the entire thing for now. So, yeah. Again, so it's important to look at wage growth, all right? Especially if you start to take things into context. Now, this is wage growth, right? compared to CPI, both year over year from the 60 up to 2026. And as you can see, there is a good enough relationship. So, now the chart is splitted in between the pre-Volcker era and the after-Volcker era. So obviously in this period, things were a little bit more volatile. If you remember the great inflation, Volcker stepping in, hiking rates to 20% in order to break the back of inflation. But after that normalization, as you can see, the relationship, it's even cleaner, right? So, and if you want a different type of chart, this is it. And again, this is divided by pre-Volcker era and post-Volcker era. Good correlation, I would say. So real wage growth, it's a leading indicator because, again, you are looking at the relationship when real wages are actually changing, right? And over the next 24 months, you have something going on with reported CPI. Because of what? I mean, because if your wage is not, or your salary, it's not growing fast enough to keep the pace with inflation, with a lag, if you stop spending or if you cannot afford the stuff you could before, you're going to pull out from, your spending activities. And so prices will need to adjust down to meet demand, which is now evaporating at those higher prices. So obviously there is a lag, especially because consumers are always particularly creative, right? Yeah, my wage is going down, but you know what? Now I got these buy now, pay later, or I can just max out my credit card and I'm going to think about this problem in 3 or 6 months, who knows? But for now, I'm keep on spending. So again, it's normal that there is a lag for many different factors, all right? But nonetheless, the relationship is there over a long enough period of time, all right? So if you look at real wages, so basically the wage growth minus reported inflation, kind of like what we do with retail sales. It's kind of the same logic, all right? You see that every time real wages go negative, it's not a good time, right? So again, and of course, if you look at the shaded area, you know what they are, right? And I mean, they are contraction basically, and it's hard to think about inflation if people are not able to spend to keep up the pace, right, with current prices. So that would be it. The 2008 cycle peak, when you look at, when wages actually picked up and started to roll over, and then, with a little bit of a lag, again, we got 2008. Curiously enough, even in this period, we got some sort of an energy crisis because I remember oil actually went up 55% to compound the oil crisis. It was before the old things, the old house of cards actually crumbled, but there was, even in there, an energy crisis component. And when you compare it with the current cycle we could be in, wage growth actually peaked in March 2022. After 3 months, you've seen what? CPI peaking out at 9.1% or whatever you, and it kept on going down and down and down again. So again, now we have, even in here, some sort of an energy crisis, which if you just look at the percentage, right? And I mean how much the oil price went up, now compared to 2008, the shock was even more severe this time around, because 2008 was 55%. This time around, I think it was 60 or something. So, it's just a minor discrepancy, but for analog lovers out there. So even in this case, if you see energy normalizing and if you see wage keep on not growing, it's hard to expect, that runaway inflation people are so worried about, okay? So just, to compound the whole thing, right? Trueflation, both for CPI and PCE, they are both around respectively 1.8 and 2.2. And again, this is interesting. FedWatch dropped again as for the possibility of a hike. I think last week it was 30 in the 30s, and now it's down to 20. So, again, knee-jerk reaction initially after Warsh released that initial press conference, and now they're pricing in basically most likely another pause, right? Which again, I think that's the story. I'm really not expecting the Fed to hike, all right? Maybe they will postpone further cuts and they'll take a wait and see stance. But I mean, if they really hike, either something big is going to happen overall, or they are really, at that point, they are really nuts. So, we'll see about that. Credit spreads, nothing changed in here, relatively tame. Actually, they came back down this week, so, nothing to see here for now. All right, so after that, let's have a look at the charts and, let's keep on moving on. Now, as for the charts, as usual, DXY, no surprises. We were looking for a little bit of a pullback. It looks like we had it. It's not huge, obviously, for now, at the very least. But, I mean, there was a huge spike. We said the market looks a bit overbought now. Maybe we will see a pullback, or at the very least for now. I guess you could still consider it a consolidation. But yeah, we are basically where kind of at the old levels when, you remember we were considering this whole area right here as range high, right? Looks like we are basically there. So, could this be a retest? Break, retest, confirmed, breakdown, breakout, and up we go? It could. Or, I mean, maybe could come a little bit lower before bouncing, but nonetheless, I guess expectations were met for a pullback, so we'll see from here where we go. The scenario is obviously the same, either continuation or falling back in the old range. So that was a failed attempt on, we keep on maintaining the 99 levels for God knows how long, right? Other currencies, it's basically the same. Generalized pullback, the euro, tiny little pullback, tiny little bounce. Pound, sure, a bit more volatile, but kind of the same. Even the yen tried to put together a bounce. I think I was reading throughout the week that there was the suspect of another BOJ intervention, because we all know that those interventions, they work so well that you need to keep on doing them. But, at the same time, look, beyond the irony, they need to do something, all right? It's not like they... As an institution, you can't just stay there seeing your currency, being, sold off like that, seeing it plummeting and not doing anything. It's, at that point, why do you even exist as an institution, right? So you need to do something. Will it work? Most likely not, if it's not the market to change his mind around, but you need to do it. Plus, at a point, I guess, as a country or as a central bank, I'm talking about Japan and the Bank of Japan, I guess at a point you could also force the hand of some other friendly government or some friendly central bank. Thinking about who? Well, the Fed in the US. Now you may say, why? Why should the US or the Fed even care? Well, if the Japanese yen goes down so harshly, and they are basically the biggest holder of US treasuries, what if they, even more, they transition from a net buyer to a net seller? They keep on selling the treasuries, yields keep on spiking up, and you have a problem now domestically at home. So at the point, I guess you have the incentive structure to at least try and help them out. It could be with swap lines, it could be with whatever, or open market operations in conjunction in between the two central banks. One could be, well, you know what, we commit ourselves to buy XYZ amount of yen, right? And you are basically helping the BOJ to bail out their own currency in a way. So again, you are incentivizing doing it just because it would impact your domestic treasury market in a way. But the counter is that you can't help them out in doing it too quickly, or you can't be too visible, because if the market sniffs that out, what could happen is that you cause a repricing of the yen to the upside too sharp and too quick. And at that point, you start to crack the carry trade. And then, sure, your treasury market is safe domestically in the US, but maybe now you have the stock market plummeting. As we've seen last year in August, it plummeted 10% in a week because there was overall, in the grand scheme of things, a tiny little movement in the yen and the carry trade going a little bit wobbling, right? So it's not easy to manage this stuff, all right? And then the other currencies are pretty much the same. I mean, nothing really changed. If not, I guess at this point we could categorize the Indian rupee as negatively correlated to the rest, because when everything was pulling back, the Indian rupee was looking like it was putting together a bottom, or a bottoming attempt, so to speak. And then this week, Chinese yuan it obviously bounced, South African rand bounced, Russian ruble, even this one. So pretty much everything across the board attempted a bounce, and instead the Indian rupee, it took another nosedive down. So I don't know, there must be something which is causing it to be so negatively correlated to the rest at this moment in time. Could this be different later on? Maybe it could, but for now, this is it. Now, okay, so since every single week, and I get it, I know for some people it could be boring, right? But I always spend a good amount of time, at least 10 minutes, talking about currencies, all right? And you may wonder, who cares? Currencies are boring, they move slow, which is true. I mean, compared to NASDAQ futures, they actually move particularly slow. But I'm going to give you an example of why I'm always monitoring currencies, all right? So take this one, for instance. We are a little bit back in time, right? This is 2018. And I'm taking the SPY ETF, so the Spiders ETF, right? Here we got Euro USD. So my own currencies, I picked my own, right? You could do the same thought experiment with your local currency. Could be yen, could be renminbi, could be New Zealand dollars. But guess who the fuck would want New Zealand dollars, right, Wally? But you could do it with whatever currency you want. I was just looking at this, right, to tell you. In this period, right, you see the stock market plummeting 18%, right? Okay. Now, the Euro USD exchange rate went down almost 4%. And gold actually went up some 5.5, 6%, let's call it. So now you may say, I live in America. All my expenses are denominated in dollars. My portfolio is denominated in dollars. So who the fuck cares what's going on with the euro or the rest of the world? Yeah, but you need to realize, even as an American, that a lot of capital flows, a lot of money are moving in and out your domestic markets every single week, every single month. And for those people outside of the US, these currency movements, they count a lot, all right? Now, in this situation right here, obviously, if I'm European and I have my money in the stock market, nominally I'm going down 18%. On top of it, I need to add that my currency is losing 4% against the US dollar, and these assets I'm holding are denominated in dollars. So I'm down more than 18, right? Conversely, if I'm basically, I see the market going down, I put my money into gold. Now what do I see? I see gold going up 5.5%, and gold is denominated in dollars, right? It's priced in dollars. So now gold is up 5.5%. My local currency is down against the US dollar, almost 4%. If I put my money in gold instead of keep on holding the S&P, instead of being down some 22%, I could be up like 9% when you account for the currency exchange rate, all right? So this is why for us, it counts a lot how our local currency is moving relative to yours in America, and then relative to different asset classes which are priced in dollars. One of the big, one of the luckiest thing an American actually have is that you don't have to think in multiple currencies when you try to do these things, all right? Which, again, it could be a double-edged sword, I guess, because then the counter for that is that most Americans, at least, the one I talked to, right, those people I had the pleasure to talk with throughout the years, they're not really aware about all the dynamics of, you know, the dollar against other currencies and how it can impact capital flows, which is a limit. It is a limiting factor overall if you're trying to understand global macro. If you don't understand the dollar, you can't pretend to understand global macro at the end of the day, all right? Now, take this other instance. Like from here, after this correction, so to speak, now the market went up 40%, right? In dollars, right? And over the same period, still, my example, I'm European, right? My local currency is going down another 5% against the dollar. So if I put my money back into the S&P, I'm up more than 40%. In my local denomination, I'm up some 45, right? And again, same with gold. Gold was up, what, 35? And again, I would be up 40% since it's priced in dollars. So, you know, you start to see the relationship there. Now, look at that. In 2022, there was that major recession scare. The S&P, or at least, you know, SPY ETFs, it dropped from the peak in here 25%, okay? I'm using closes just for the sake of it, right? Not using absolute highs and lows, but regardless. Now, you may say, oh, that it was terrible to hold throughout that period. Was it? I mean, sure, if you are thinking in dollars, you were down 25%. But since the euro kept on losing another 15% against the dollar, I'm a European, yeah? So I'm still down, sure, but I'm not down 25% in my currency terms. I'm down like 10%. And again, if throughout this period I was putting my money in gold rather than holding the S&P, gold was down what? 10%, but my currency is down 14, 15% against the dollars. Gold happened to be priced in dollars. I would be up, all things considered, roughly 5%. Because at the end of the day, I'm making the calculations in my own currency. I need to look at the final returns denominated in my own currency, the euro. Because at the end of the day, my expenses are denominated in euros. My mortgage, my gas, my electricity bill, my whatever, the food I buy, the clothes I need to wear throughout the winter to stay warm, they are all denominated in euros. So for me, at the end of the day, yeah, I'm playing the market in the US, but if I'm playing for, you know, these type of longer time frame swings, I need to assess FX risk, all right? So, you know, other examples in here. This one is one where actually it could work in reverse. You remember the tariffs, right? So at the beginning of 2025, Trump gets elected, and then you got tariffs, and then there was the shock because the tariffs were way higher than what anticipated by the market. So you may say, okay, the market goes down 20%, and this time around, the euro would be up 8% against the dollar. So contrary to the previous iterations, if I'm staying in here now, I'm losing more than what the market is down for an average American, which is thinking in dollars. It would be down 20%. I would be down even more, I guess. Because, you know, the market goes down 20% and the dollar is losing 8% against my local denomination. So I'm down 27%. You know, if at the trough of the market, I would sell the position, getting back the dollars and then swapping the dollars back for euros, I would swap back dollars, which are now worth less since the euro went up. So, you know, again, and that, I guess that's, I don't know if it is a cause, it's a kind of a chicken of the egg type of game, but I don't know if we've seen this dynamic because there was this theme about sell America, right? Or it was the dynamic which caused the narrative about selling America to emerge. But nonetheless, you see that it's a complete different situation depending on where my currency is going compared to the US dollar, right? And again, even this one right here, just to close up, the correction which started at the beginning of 2026 was a 9% correction overall throughout that same amount of time. The euro stayed relatively flat. Yeah, I mean, it lost 2% against the dollar, so I would have been down like maybe 10, 11% holding this correction in my monetary terms, right? My currency terms. But when it goes up what, 20% after the April lows. And throughout that same amount of time, the euro is initially is going up, but then, you know, it pulled back a lot. So now it would be flat. So I would have the convenience in staying denominated and invested in the US markets because, you know, my currency didn't move and the markets went up. So I would have, you know, enjoyed the appreciation of the market in its nominal terms at this point, roughly speaking. All right. Curiously, if throughout these two things, these two movements, swings, I would have, you know, switched back to gold. This time around, I guess I would have lost it because, I mean, well, the first iteration, maybe not. Like gold was down. Well, I mean, initially it went up, so I would have absorbed this drop, right? So yeah, and then when, you know, we have the bounce, gold actually plummet. So, you know, at this point, I don't have any interest in staying in gold, whatever my currency is doing against the US dollar, I guess, especially because it's staying flat. So, but, you know, just to understand why it's important for me, but for many other people which are not living in the US, to understand how the dollar is moving, what type of expectations you have on the dollar compared to your own local currency. You need, for us, we need to start from the dollar first when it comes down to medium to long-term positions, right? If you're talking about day trading, who cares, right? I can day trade Nasdaq futures every single day, and I'm not expecting the euro and the dollar to move relative to each other 10% in a day, right? So who cares? At the end of the day, I'm going to withdraw the profits, and that type of FX rates, it's basically non-existent. But if you put on positions which are set up to last more than 2 weeks, 4 weeks, 5 weeks, or months, you need to take this into account, right? Now, after that, let's have a look at Bitcoin instead, which, you know, bounced, a very nice bounce, to be fair. Monday, it was basically a little bit of a indecision day, and then we got Tuesday down, and then a huge bounce for the rest of the week. So, you know, I think this chart is basically a representation of a lot of what we are going to see throughout the rest. Is it out of the woods? Well, we are basically testing back into resistance. So for now, I would say no, it's not. But, you know, on the other side, if we look at, I mean, MicroStrategy had a little bit of a bounce. I think the preferred, let's have a look at Stretch. That was a huge bounce. I mean, huge in the sense that instead of being like what, 25% below par, it's now only 13% below par. So it regained half of the, you know, the losses. Is it, you know, is it all done? I mean, Stretch is safe now. I guess the risk is still there, all things considered. But look, again, what we've seen in these previous iterations, it would be, I guess, normal to see this market kind of trying to back in line with the parity level, I guess. I mean, it should be a money market fund, for fuck's sake. But I guess a lot of what we're seeing now is a little bit, first of all, mean reversion. And then I think, you know, again, Michael Saylor, it's pretty good at talking his book. So, you know, plus he could actually sell the Bitcoin if he needs. So again, I guess at the very end of the day, that kind of creates the incentive structure to, you know, maybe to be a buyer. As crazy as it might sound, but would you be a buyer of Stretch? I think I was reflecting about this thing just last week. I actually posted on Discord. I might include a screenshot of my reasoning behind, you know, I would hold Stretch now rather than Bitcoin from a risk-adjusted standpoint, right? But other than that, I think nothing really changed. I guess, you know, you could hope, obviously, for a market to recover this level, having a little bit of a starter step in here again, maybe another drop, and then trying to push higher. I'm not expecting it, to be quite honest. My expectations, if I wanted to be a little bit more bullish, would be a little bit of a retracement here, and then trying to go sideways in here. I think we would need to build up a base first, and then trying to build up the structure to the upside. Still have this tiny little pocket of inefficient trading in here. So who knows, right? Obviously, what you don't want to see, it's a sharp rejection in here and immediately the market plummeting back to new lows. But that's, that's quite obvious at this point, right? So other than that, nothing else to see here for me. It's just, sure, we got the bounce. Nice. Let's see how this bounce actually keeps on going. Is it faded once again, or can we really see some sort of a changing behavior? Again, I'm very slow in changing my attitude to markets. I'm never going to time the bottom perfectly. That's not my job. It's not my intention. My intention is actually to wait for actual reversals or tops to be put in and then to trade the market in the new established direction. So you're never going to hear me nailing a top or a bottom, I guess, right? Gold instead, kind of the same. I mean, we had the bounce, some sort of it's not really a double bottom, but double attempt to keep on going down. It was rejected. It was bought up. So we had the bounce. Point of release right now, providing resistance. So basically, same exact logic I would apply on gold. You could take the segment about Bitcoin, copy paste it, and yeah, I would take it like that. Even with this one, just to not waste a lot of time on this one. It's basically the same, right? I mean, do you see a sharp rejection here? Bad, all right? Do you see it being rejected and trying to establish some sort of a base, a reaccumulation, and this turns out to be some sort of a triangle in here? Okay, maybe constructive. Do we V-shape? So you see basically it going back up again violently. Okay, I'm not counting on this one, but yeah, I mean, these are the three scenarios, I guess. And even in this case, my base case would be a little bit of sideways, right? So, we'll see. Other metals, they all did the same, right? See, extension filled back into what? Previous base. Do we confirm it now as resistance? Maybe, we'll see. And same in platinum, but all across the board. Copper instead, for now, it's maintaining itself a little bit, more bullish compared to anything else. We were looking at this point of release in here, in this pocket, in here, provided the bounce. We already tested the, expected resistance now. And again, we've seen the rejection, but it looks like over the past, last 2 days, we've seen a little bit of a reaccumulation and maybe a new attempt higher, which is basically, the case for Bitcoin, for gold, right? Initial pullback, but then trying again higher, right? It looks like copper is already doing it. We'll see. It's not confirmed yet, obviously, but, that would kind of be my base case for gold and Bitcoin. Down, pullback, and then it goes sideways for a little while, right? We'll see. What about oil? Oil completely filled the gap, which obviously was created when the war actually started. I think at this point, I mean, should we just delete this old range in here? I mean, it's just getting in the way. Yeah, okay. So what now? Oh, I mean, I guess now it's time to come up with new levels because, I mean, all of these, I know it looks very, in the distant past. Just remember, it takes a tiny little thing to maybe provoke a huge bounce in oil, especially because, sure, now at the current moment in time, the traffic throughout the Strait of Hormuz is actually partially reestablished. News, when was it? Thursday, they were talking about 35 ships per day, which is not, a huge number compared to pre-war. We were talking about 100 or 110 ships per day, but 35 is better than nothing, and hopefully we can keep on building that number up and getting back to normal. But it just takes a missile, a drone, whatever, to reignite the entire military conflict at scale. So just a little bit cautious here. Although what I wanted to see at the end of the day, it played out. It took a while, obviously. It took 2-3 months, but sometimes if you have patience, that's what you get. for the longest time throughout April or May, you have read and heard about people ringing the alarm about oil going to 200, 250. Yeah, sure. With what money? With what money? So, and of course, I mean, you also may say, well, it's normal that we got these quote unquote pause in the conflict because sure, both parties was enticed in having it. Iran to reconstitute its forces, to rebuild up some infrastructure, and the US for political reasons. And then we are getting into the summer, and would be unpopular to force people which are now willing to travel for vacations and holidays, and they have to pay what, $5 a gallon, ahead of midterms, right? So I guess both parties involved wanted this situation to cool off a bit, and maybe, who knows, in the future, in autumn, right after the midterms, they got back to bomb the shit out of them. Who knows? But for now, look, I think it's a big if we are going to see a bounce, I would like this. What did I press? Okay. I would like this region right here for an initial bounce, right? Obviously, this one, it's not bad too, all things considered. Looks like a good level. It looks a bit sketchy on a daily time frame, but I guess if you zoom in, yeah, see, it matches up, right? Initial bounce, and then the market started hovering around, showing weakness, and then it went down. So this was kind of support, although for the short term, and then it could be resistance if we bounce from here, right? Who knows? And this level right here, yeah, sure, it was some sort of a base in here. The initial drop was absorbed in here, and then we cracked it. We tried to bounce, faded, another bounce, faded. So yeah, I mean, these two levels. Just zooming in. I mean, when your eye it's kind of trained well enough, you start to see these things even on a daily time frame. Although, it looks like it doesn't make sense, right? When you're just looking at a daily time frame. But I mean, the more you zoom in, the more you see that overall there were structures and patterns being developed at those levels. It just takes a bit of time to train the eye, I guess. But as you can see, you can come up with something then when you zoom in. So, oil for now. If it keeps on dropping, well, good news, right? I mean, overall, it would be a breath of fresh air for the global economy, I guess. So, not bad, right? Now, let's have a look instead at the treasuries, which, this week they actually came back down again. Although, I mean, we were looking at a flattener previous weeks. What do we have this week? Because the long end went up and the short end stayed relatively muted. I mean, are we changing behavior once again? I mean, at this point, it is changing so quickly that it's hard to keep the pace. Look, from a price action standpoint, I guess you could say, look, the long end, as for the yields, it just bounced off of a level which was already there in the past, right? So nothing new in here, right? And you could say the same for the medium end. So basically your 10 years, it came back in here quite impulsively, and therefore it bounced back quite impulsively, right? I guess, again, they're going to ebb and flow a lot, but as we were discussing in the initial segment, I don't really see the case for inflation to be sustained at, very high levels. I'm talking about 5, 6, 7%. Therefore, I'm not seeing, for now, right, so far, the risk for yields to go to 5, 6, 7%. Now, you may say, okay, what about, again, getting back to the dollar, right? What about the dollar actually bouncing in here and keep on drifting higher? So doing what? Forcing all these currencies down, and what they need to do to defend them, they need to sell the treasuries, which would cause what? A spike in the yields. So that type of a price movement would be more some sort of a mechanical type of reaction and dynamic rather than something which is maybe only just based on US domestic fundamentals. But nonetheless, the case is there, and I don't want to discard that, because when you start to disregard things, that's usually when you may put yourself into trouble. So just bear in mind the possibility is there. It could be a mechanical reaction which has nothing to do with fundamentals maybe, and you may staring at the chart saying, I'm taking me as an example, oh well, but I mean the labor market, wages growing or not growing, they would point toward a disinflationary period, and I wonder why yields are spiking. Well, because it's a dollar which is ruining everything, right? The wrecking ball of the dollar, it's causing other currencies and other governments to sell the treasuries just to defend the currency. So this is why you see yields in the US spiking, right? So again, it's you need to have a thesis, and then you need to have the counter to that thesis, although it's your own. But you need to know where and how and why you could be potentially wrong, right? So that you can manage the risk. Okay. So after that, we will have a look at the stock market, which was particularly dull this week, and then we're gonna wrap up the video for the day. So let's have a look at these equities, and let's start out with E-mini, S&P futures, and NQ Nasdaq futures, because right off the bat you can see that there is a little bit. It's not really a divergence, but it could be a shift in relative strength. All right, I mean the quote-unquote precursors for that were already in here last week, or if you remember. And here is pretty much evident. Let's have a look at it. Look at the weekly open, right? You see that, for instance, the S&P never retests it, right? While the Nasdaq instead, it came very, very close to it. Okay, and then they both bounced off of it, but I mean, look at where the Nasdaq is closing relative to the high, which was recorded throughout the week on Wednesday. While instead, look where the S&P is closing relative to the high, which was put in on Thursday. And even on Thursday, what you see on Thursday, S&P making new highs relative to the previous days. Nasdaq, not quite, not even close to the Wednesday high, right? So when you zoom out, what you see is this. You see, obviously, Nasdaq, which is a little bit weaker than the rest, especially compared to the Dow. Now, this could be important. And look, just a little bit of a disclaimer. I'm going to do what you see a lot of other influencers and YouTubers doing all across the board, right? But, it's not a one-off, but I just think it may be a little bit, it is a statistical truth at the end of the day. So we're going to take, in this chart right here, the NDX, right? So the index itself for the Nasdaq, and let's go on a daily time frame, right? Okay, and then on the other one, we are gonna take the DJI, which should be the index for the Dow. There you go. So as you can see, there is a divergence in here because the Dow is making a high, the Nasdaq it's not. But let's have a look at these, for instance. Let's get back to here, but I guess it would be enough even in here. Yeah. Let's start out from here. So the Dow is up. Do I want to go on a weekly chart? Let's see. Yeah, maybe it's even better. All right. So the Dow over the last 2 weeks, right, is up what? Some 2.6%, I guess. While instead the Nasdaq over the same time span is down what? 4%, right? So one is up, one is down, and the delta in between the two, if you remember, right? Up 2.6, down 4, down 4 essentially. So the delta should be 6.6%. All right. So up until this point, we're all clear. Why it's important? I mean, it's funny and interesting to look at the delta, this delta right here, because historically, when you see the Dow overperforming the Nasdaq, right, for more than 7 days in a row, which in this case it absolutely happened. We have been looking at a weekly time frame on 2 candles or 2 weeks, right? It's not a good sign. Now you may say, well, maybe it's just another rotation. The Mag 7 and the semiconductors, they were a little bit of a bot, so money rotated back into the industrial sector because of this and that. Maybe, could be whatever. You could put on it whatever label you want. Also, when you think about the Dow Jones being an industrial average, are you sure about that? I mean, have you checked what stocks are in there? I think even Google was added to it this week. So, maybe it was in the past an industrial type of index. Today, I don't know. You put Google in, you take Verizon out. Who knows, right? But nonetheless, regardless of definitions. But if you ask, in this case, I asked Gemini, right? Because I was curious. So, I mean, there are historical precedents for these type of divergence. The problem is that, this setup, right, it leads to a bad market, basically a 20% or more decline from the highs with a 67% probability. Now, sure, it's basically 2 in 3, so there is still 1 in 3 chances that this is not going to happen. They talk about violent structural rotation. Obviously, the Nasdaq is heavily weighted toward technology, high growth equities. The Dow, sure, anchored by established value and cyclical companies. Maybe not so much anymore, but still, the logic would stick. The mechanic of this divergence, obviously, it's because the market, it's behaving like this because what do they anticipate? And again, look at the probabilities. There is 1 in 3 chances that what the market is anticipating, it could be wrong, okay? Economic slowdown or recession. I think it's a little bit premature to talk about recessions now, but I mean, looking at the labor market data, a little bit of a slowdown, getting especially into next year, who knows, right? Restrictive shift in monetary policy. I don't know, in the sense that Warsh, it's talking particularly hawkish for now. Can it be able to deliver? I don't know. It depends on what the markets will do. Because if there's one thing I'm sure about, right, is that if the market is down 20%, he is not going to be hawkish, right? Okay. And a systematic shock. I mean, about what? A shock could be, I don't know, they're talking about high valuations, but could be more of a story about returns, like all these capex, and we don't see the return on investment because, well, nobody's using this tech, or at least those $20 per month subscriptions are not going to cut it when it comes down to re-enter from these old capex and infrastructure build-out. Or could also be some sort of a physical limit. I mean, yeah, we spent a lot, but then we do realize that we don't have another important component which is needed to keep on, making these data center work, which is what? Energy. And there is, a little bit of, don't want to call it confusion, but there is a little bit of rejection against these data center to be built up. It's the old NIMBY story, not in my backyard. Because when you build up this type of data center, all the locals in the area, well, I mean, first of all, it's not pretty to see, right? Then it's going to maybe pollute the air around, maybe, who knows. One thing it's going to do, it's going to drain a lot of electricity from the grid. So do you really want to see your electricity bill going up just because they are building a data center 5 miles away from your home, right? So there is a little bit of a pushback. I was reading in the press, so who knows? That could be the change in the narrative. I mean, look, there are many different reasons by which this entire AI bubble could burst, right? But what I'm also trying to keep in mind is that if I can think of all these things, if I can see them coming in an undefined, distant future, wouldn't you think the market already knows? it should be already priced in. If a stupid idiot like me sitting at home in the middle of Italy can already see these things and how things could go south, would you think people with billions, which are paid to know ahead of anyone else, wouldn't know already? So I think it's already priced in at the end of the day. It would be, again, some sort of an exogenous event which will throw the entire narrative in the trash bin. Like, I don't know, maybe, do you remember the DeepSeek type of moment last year? Who knows? Maybe reality is that in 6, 12, 18 months, something will come around and it turns out that we don't need to spend billions in these data centers to generate that amount of computing power or capacity. We just need to work on the software and build up a better software, which is doing kind of the same thing, but really consuming half of the resources from a computational standpoint and maybe being 30-40% more energy efficient. Who knows, right? So it's a long story. The thing is, at the end of the day, that after you see these divergence, what typically happens, and again, 67% of the times, not every time, is that you see erosion of market breadth, the risk of contagion, and basically the market dropping 20% or more. 20% they're talking about the S&P, but since we were looking at the divergence in between NDX and the Dow, I mean, NDX is by nature much more volatile. So, if the S&P is down 20-25%, the Nasdaq could be down what? Maybe 30, 35? Who knows, right? So, I mean, there is a lot of doom and gloom in this type of segment in here. I'm not saying I'm expecting the market to plummet. Absolutely not. Not next week, not next month. I'm just bringing up some sort of statistical relevancy, which, again, it holds truth in the past. But, don't forget the 33% false alarm scenario, right? So it's worth noting that this signal, it's not an absolute guarantee as anything else in markets, right? So a third of the time, the market digests its violent rotation. And at the end of the day, things get a little bit more stable and we keep on going to the upside, all right? So it's just another thing. Then when you add it on top of what? Stuff like the seasonality throughout the summer, or the fact that we are getting into the midterm election and the market may be a little bit uncertain about what's going to happen from, a policy standpoint or legislations to come, or whatever type of regulations will hit the market, depending on who's going to win the House or the Senate, right? Or potentially gridlocks, which would be for the market, I guess, the best outcome possible, which is kind of like what we got now, because although the Republicans are basically owning the House and the Senate, the Democrats have enough power to basically stop whatever to pass through. So they are not passing any meaningful legislation over the past few months, and I guess the market actually liked that, right? So that was the thing with this ominous signal. Now, getting back to the technicals, right? You can see the divergence in the Qs going down and, SPY being relatively up. I think, again, it could be a rotation, sure. A lot of of what we're seeing, it could also be these, for instance, quarter-end rebalancing. And throughout this rebalancing period, look at if you look at the prime book, right? This should be, I think this should be Goldman Sachs, but a lot of people actually, stopped being net buyers of tech, right? Especially for the Magnificent Seven right here, the Mag 7, right? Now you got that meme going around from Mag 7 to Lag 7 because they are lagging the market, right? The internet is fantastic, by the way. So, but is it a said and done deal, or it's just a rebalancing type of stuff, right? Because, again, then you look at the individual stocks this week alone, right? And I see, for instance, let's go on the weekly time frame. Apple, up. Amazon, positive. Google, positive. Meta, positive, but don't like this rejection in here. Microsoft, positive, at least it's bouncing. Nvidia, doji, so indecision, but still the structure is pretty good. Tesla again, kind of like Meta, I guess. So I mean, there was buying pressure in the Mag 7 this week, I guess. So look, we have seen many different rotations from value back to growth, and then back to value, and then back to growth. So at the end of the day, I think when you factor in all the stuff, especially the rotation for the rebalancing thing at the quarter end, all things considered, I think you need to have a look at these. These are basically the profit margins of the Mag 7 against the rest of the S&P. So again, if you think about putting money in something because you think they're going to increase profits, that the company is going to perform good, would you pick any other of the 493 companies in the S&P when the Mag 7 is basically obliterating everything? Up until the point that narrative sticks, I wouldn't know why you would pick something else, right? And look at that. It's another thing. Now these basically APS, so earnings per share growth. Of course, this is a projection, right? It's not a done deal. But this is basically energy and infotech against the rest of the market. So, if you think about the fundamentals over the medium to long term, you should still look at the Mag 7 as the place to be if you think the market will keep on going up. Now, sure, the opposite case is, well, this is, the late cycle rotation, and from here the bubble will burst, and it's normal that, the market, it's transitioning in between the same asset class, I mean equities, from high flyer growth whatever, into something which is a little bit more perceived as safe, and then from there money will actually come out even from the safe sectors of the equity market and going to be somewhere else. Could be equities, could be gold, could be whatever, right? That could be your complete risk off scenario, right? But for now, I wouldn't call it for now. It's a little bit too early for me, all right? So, just keep on monitoring what's going on. Other things, we were talking about seasonalities, so let's have a look at these. The usual seasonality. July tends to be a pretty good month. It's not like Q4, obviously, but, throughout the summer, it's kind of the best month of the year. So maybe, we'll see what's going to happen next. And maybe, at the end of the day, it's not going to be that atrocious as a month. And here it's the same stat in another format, but, you see that. And again, this is why I was talking about, again, and I always talk about, if we are going to have a severe correction, I mean, statistically, I would expect it throughout August or September, right? Pairing it up with the 4-year presidential cycle election, right? So, did I invert that? 4-year presidential election cycle, yeah, right? With the midterm in the middle, right? So, from a seasonality standpoint, that's where I would stand for now. It is also worth noticing that if you go on a monthly time frame, right, we are basically at mid-year. We just closed the month of June, and from the start of the year, obviously the market it's up. Initial correction, but then market went up. So here's a list of what usually happened in the past, getting back, I guess, into the 50s, when the market was up between 5 and 10% in the first half of the year. So as you can see, all things considered, returns are not bad. So if you're playing for, the long run or the medium to long run, again, is seasonality right every single time? No. But it's still maybe better to consider the stats overall, right? Or, if you think there are too many numbers in here, too many columns, this is a simplified version of it. And it's, basically this. And even in here, with a different format, what you see is that the risk of subdued returns, it's basically concentrated in Q3. Ironically enough, what is Q3? Basically, the summer, right? July, August, September, all right? And after that, I mean, the full year speaks for itself, right? And even the final 6 months should be positive returns. Again, should, right? Doesn't mean it will absolutely happen, but yes, it's still something to keep in the back of your mind, right? So, yeah, quite honestly, don't have a lot to say, or to add about the stock market this week. We are going to see what type of rotation this is and how long it's going to last. I would say, again, my bet would still be on the Mag 7, all things considered. Sure, they're going to go through these periods where they maybe underperform the market for, it could be a month, right? Do you remember, I can't see it here, but it was right this year, right? At the beginning of the year, nobody wanted the Mag 7. And sure, then we got the pullback, but after that, I mean, they completely overperformed and they put the entire market in their backpack and they bring it higher. So, I guess it's hard to bet against these basket of stock in here. And even if you start to factor in the giant mindless robot, right? You think about all those flows from pension funds and whatever, they buy the S&P, they buy the ETFs, which is what basically they are buying based on market capitalization. So for every dollar which goes in, the majority of that will be allocated to the Mag 7s. That's a huge inflow of money. Plus, the ability of these big mega cap companies to perform buybacks to sustain their own stocks. So, they're growing profits, sure. So, I mean, it's hard to bet on something else. As for now, maybe it's going to be different in a month, but for now, sure. The risks are always there. CapEx, starting to slow down. The narrative to be dismantled, something coming up which makes the data center build-up obsolete, right? Yeah, sure, it could be. I'm just saying, probably it's not going to happen over the next month or two. So, I think there will be a period where the Mag 7 will keep on shining and overperforming the market before everything is said and done and the bubble, so to speak, will burst. Which, by the way, we don't know when the bubble will burst, all right? One thing is to say, I think the AI is in a bubble. Sure, okay. But you know what? There was a period, right, in here when people said, well, I think these .com stocks, they are in a bubble. And it was 1996. And then we got 1997, 98, 99. I mean, yeah, they were in a bubble. The problem with a bubble is that you don't ever know when it's going to burst. And if you get out in 1997, 1998, just because you thought it was a bubble, you are giving out the majority of the profits, which are usually coming in the later stage of every bubble, when the market just goes bananas, right? So, just, take it into context, take it with a grain of salt. Obviously, the usual advice is always apply, rebalance huge winners and huge runners, take money off the table when you can, when the market make them available, and then redeploy them when the market looks a little bit more fairly valued, right? And always try to assess risk. That there's anything else, right? Okay. So with that, I'm going to leave you off. I hope you had a very good 4th of July down there on the other side of the pond. And as for the rest, I mean, in Europe, it's still business as usual. Nothing ever happens, gladly, because when something really big happens in here, it's usually bad. So, hope you're going to have a nice start of the week. And, with that said, be nice and be cool. Niels out.
Mm-hmm. 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 Come on. Mm-hmm. Mm-hmm.